Imagine you're planning this massive cross-country road trip. You wouldn't, you know, choose a low-clearance sports car to go off-road.
Oh, definitely not.
Right, and you certainly wouldn't drive some heavy-duty, gas-guzzling truck if you were just cruising down a perfectly paved highway.
Yeah, you just be burning fuel for no reason.
Exactly. Choosing the wrong vehicle for the terrain leaves you burning fuel unnecessarily, or worse, completely stranded. And the crazy thing is, it happens every single day. Not on the highway, but in the real estate market.
Oh, all the time.
Usually when you think about buying a house, you obsess over the property itself, right? The neighborhood, the school district, the granite countertops.
The fun stuff.
Right, the fun stuff. But picking the wrong home loan program to buy that house can cost an average buyer $40,000 to $60,000 over a 30-year period.
Yeah.
Let that sink in. Just checking the wrong box on your financing could cost you the equivalent of a luxury car in pure evaporated cash.
It's staggering when you put it in those terms. And the real tragedy is that most people don't even realize they've made a mistake until years down the line.
Because they're just paying the bill every month.
Exactly. They look at their statements, they see their loan balance barely moving, and they wonder where all their money is actually going. I mean, they were playing by the rules, but they just didn't understand the underlying math of the loan they picked.
Well, our mission today is to make sure that doesn't happen to you. We're doing a deep dive into the 2026 first-time homebuyer options, specifically for the Triad area of North Carolina.
Which is a very unique market right now.
Very much so. So we're looking at the four major paths: conventional, FHA, VA, and USDA. And we aren't going to talk down to you or, pretend the industry jargon doesn't exist. Instead, we're going to break down exactly how these financial mechanisms work in everyday language so you can make the smartest financial decision possible. Okay, let's unpack this. We're pulling all our insights today from a fantastic resource, the complete Triad NC First-Time Homebuyer Loan Guide 2026.
And, before we even touch on those four specific loan types, we really have to clear the air and bust the single biggest myth in real estate.
Let me guess, the down payment.
Yes, it's this massive generational hangover. The idea that you absolutely must save up a 20% down payment before you can even think about buying a home.
Which is just ingrained in us from our parents, right?
Right, but clinging to that myth in today's market is financially destructive. Renters who wait to save a full 20% end up costing themselves an average of 7 years of building their own equity.
Because inflation and rising home prices effectively outpace their ability to save. You're basically trying to fill a bucket with a hole in the bottom.
Precisely. If home values rise by just, say, 4% a year, the target you're trying to hit just keeps moving further away. You spend 7 extra years paying off a landlord's mortgage instead of your own, all because you thought you needed this arbitrary pile of cash to get started.
So let's ground this in some real numbers for the 2026 Triad market so you know what you actually need to bring to the table. The median home price in the Triad right now is sitting around $385,000.
Give or take, yeah.
Right. It shifts a bit depending on the specific city. Like Winston-Salem averages around $370,000.
High Point is historically a bit more affordable, usually coming in around $260,000.
But then if you look at places like Kernersville or Clemens, which have closer proximity to certain job hubs and, newer amenities, you are pushing up into the 400,000s.
Yeah, and using that median of $385,000 as our baseline illustrates the problem perfectly. If you were stubbornly trying to save 20% for that home, you'd be trying to scrape together $77,000 in cash.
Which is wild.
It is. For a first-time buyer paying current rental rates, accumulating that much cash on hand is incredibly difficult.
It's like waiting to buy a car until you have the cash for the entire thing in a briefcase. You lose out on the utility of the vehicle while you wait, and you're just walking everywhere for years.
That's a great way to look at it.
The reality of the entry-level loans we're looking at is that the required down payments range from 0 to just 5%.
Which is a game changer.
Huge. On that $385,000 home, a 5% down payment is $19,250. And if you drop down to a 3.5% program, you're only looking at $13,475.
Which is a much more attainable savings goal.
Totally. But let me push back on the mechanism here for a second. If you're putting so little money down up front, you're borrowing a much larger amount. Doesn't that make your monthly mortgage payment absolutely skyrocket?
It's a really logical assumption. But the math behind paying off a mortgage over time tells a different story.
Hmm.
When you compare putting 5% down versus putting 3.5% down on that same house, you're talking about a difference in your loan amount of roughly $6,000.
Okay.
Because that $6,000 is spread out over 360 months, 30 years, at a relatively low interest rate. The difference in your monthly payment is only about $130 a month.
Oh, wow. So the benefit of keeping $6,000 in your pocket far outweighs that small monthly cost.
Exactly. By needing less cash up front, that 3.5% down payment gets a buyer into a home an entire year earlier. You trade $130 a month for a 12-month head start on building real wealth and, locking in your housing costs while rent just continues to climb.
Which naturally brings us to the two most common ways to actually buy that house: the conventional path and the FHA path.
Right. These two programs make up the vast majority of first-time buyer loans, but they are engineered for very, very different types of borrowers.
So let's start with conventional. This program requires somewhere between 3 to 5% down. The stated minimum credit score allowed is a 620. But the guide makes it clear that conventional mathematically shines for buyers who have really strong credit, meaning a 720 or higher and very stable income.
Yeah, because conventional loans utilize a pricing model based on risk adjustments. A mortgage rate isn't just one standard number on a billboard. It's a matrix. Lenders are constantly adjusting the underlying costs and interest rates based on how risky they perceive you to be.
Makes sense.
If your credit score is flawless, a conventional loan rewards you with great terms. But the moment your score dips into the high 600s, lenders start heavily taxing that risk with higher interest rates and steeper fees.
So it's almost like a cascading penalty. If your credit is slightly dinged, you don't just get a slightly worse rate. You effectively get priced out of the conventional path altogether because those adjustments make the loan just too expensive to carry.
That is the exact mechanism at play, yes.
So then there's the FHA path. This one requires 3.5% down, and the credit floor drops significantly, all the way down to a 580 credit score.
Quite a bit lower.
Yeah. So if conventional is considered the gold standard, why would anyone with decent credit, say like a 680, choose FHA? Is it just a fallback option for people with bad credit?
What's fascinating here is that FHA is absolutely not a penalty box for bad credit. FHA loans are backed by the Federal Housing Administration, which is part of the government.
Okay.
Because the government is effectively insuring the lender against the risk of you defaulting, the lender doesn't need to penalize your interest rate as heavily for a lower credit score. The government absorbs that risk.
Oh, I see.
So if your credit score is sitting anywhere between 580 and 719, an FHA loan usually offers a significantly better underlying interest rate than a conventional loan would for that exact same person. FHA actually becomes a financially smarter choice for that middle tier of credit scores.
But wait, if FHA is so forgiving on the interest rate side, the bank has to be hedging its bets somewhere else, right? There have to be a trade-off.
There's always a trade-off.
This leads us to the biggest hidden cost of buying a home with a small down payment: the safety net fees. You'll hear the industry call it PMI for conventional loans or MIP for FHA loans. But ultimately, it's a mandatory fee you pay every month to protect the lender in case you stop making payments.
Yeah, it's basically the systemic cost of admission for not bringing 20% to the closing table. And how these two programs structure this fee is the single most important factor in choosing between them.
So looking at conventional loans first, on a typical loan of around $366,000, private mortgage insurance, or PMI, runs roughly $120 to $180 a month.
Which isn't nothing.
Right, but the crucial mechanic here is that it has an expiration date. Once you've paid down enough of your loan, or your home's value increases enough that you essentially own 20% of the equity, the PMI drops off automatically. Your monthly payment physically goes down.
You prove your reliability, you build your equity cushion, and the bank just removes the penalty.
Now let's look at how the FHA structures their fee, the mortgage insurance premium, or MIP. This is where the trap lies.
It's all big time.
FHA hits you twice. First, there's a hefty upfront fee just for utilizing the government program. On that same $366,000 loan amount, it adds about $6,400 directly to your total loan balance on day one.
Yep.
Then you also have a monthly fee of around $170. But the trap is that for FHA loans with the standard minimum down payment, that monthly fee never goes away. It lasts for the entire life of the loan.
It is permanently baked into your payments.
Here's where it gets really interesting. If you take a standard FHA monthly fee, let's say $150, and you multiply it by 12 months, and then multiply that by a 30-year term, you're paying over $50,000 just in bank protection fees.
It's massive.
It's a massive sum of money that does absolutely nothing to build your personal wealth. It just sits there protecting the lender for 3 decades.
Which is exactly why the financial strategy of an FHA loan dictates that you treat it as a stepping stone, not a 30-year destination.
Okay, so how does that work in practice?
Well, the strategy is to use the FHA loan to get your foot in the door because of its forgiving nature on your credit score and its lower interest rate.
Right.
You live in the house for, say, 4 or 5 years. During that time, the home naturally goes up in value, building your equity and your consistent on-time payments drastically improve your credit score.
Now, once your profile improves, you pull the ripcord.
Exactly. You refinance. Around year 4 or 5, once your credit is strong enough to bypass those conventional loan penalties we talked about earlier, you refinance out of the FHA loan and into a conventional loan.
And refinancing essentially means you're taking out a brand new loan to pay off the old one.
Right. And this new conventional loan reflects your newly improved credit and your new 20% equity position, completely eliminating that lifetime safety net fee. You utilize the FHA to acquire the asset, but you transition to the conventional loan to hold the asset long term.
That structural exit strategy completely changes how you view the FHA option. So we've covered the paths that require 3 to 5% down, the heavy-duty trucks and sports cars of the mortgage world. How do we bypass both the heavy down payment and indeed the monthly insurance fee entirely?
You look for the zero-down golden tickets.
Oh,
The VA loan and the USDA loan.
let's start with the VA loan, which is strictly for eligible veterans and active duty service members. The perks here bypass almost every traditional mortgage hurdle. 0 down payment required. No monthly mortgage insurance fees whatsoever. And they offer highly competitive interest rates.
It's an amazing program.
There is one mechanism to be aware of. A one-time funding fee, which for a first-time user putting 0 down is 2.15% of the loan. But the VA allows you to roll that directly into the loan balance, so you still preserve your cash on hand.
Yeah, the VA loan exists as a massive benefit for service members, with the Department of Veterans Affairs taking on the risk burden. Because the risk is subsidized at the federal level, lenders can offer phenomenal terms. Honestly, if you've served and have access to a VA loan, it is structurally superior to almost every other option on the table.
Then there's the USDA loan, which is basically a geographical cheat code.
That's a great way to describe it.
It's backed by the U.S. Department of Agriculture. The whole point here is about economic stimulation. The government wants to incentivize population distribution and development outside of hyper-dense urban centers. So they offer incredible loan terms if you buy in an eligible rural area.
But rural doesn't necessarily mean a farm with a dirt road.
Right. In the Triad, this zero-down program covers all of Wilkes County, most of Yadkin County, and even the outer edges of major hubs like Forsyth and Guilford counties.
You are financially rewarded simply for the GPS coordinates of the property you choose.
It's like finding a hidden menu item at a restaurant. If you know exactly where to look on the map, you unlock incredible perks. It offers 0 down, and the upfront and annual fees are significantly lower than the FHA trap we just analyzed.
There are some limits, though, right?
Yeah, because it's highly subsidized, there is an income limit to ensure it goes to the right demographic. In Forsyth County in 2026, a household of 1 to 4 people has a maximum income limit of about $129,150 to qualify.
If we connect this to the bigger picture, you see a definitive hierarchy of these loan structures. If you're buying in one of those eligible rural boundaries, or if you're a veteran, these zero-down programs are inherently stacked in your favor. They beat conventional and FHA loans almost every single time because they completely bypass the debate over credit score tiers and lifelong insurance premiums.
But we do need to do a reality check on the actual cash needed to get the keys. Because even a zero-down loan is not entirely free to execute.
Yep.
The transaction itself has mechanics that cost money, specifically closing costs. In the Triad, closing costs generally run about 2 to 4% of the purchase price. On a typical home, you need to be prepared for an additional like $7,700 to over $15,000 in various origination fees, taxes, and prepayments.
The down payment is really just one fraction of the cash-to-close equation. However, the legal setup in North Carolina actually saves buyers a decent amount of money here. North Carolina is an attorney-closing state.
meaning real estate attorneys handled the title work, the deed transfers, and the actual transaction, as opposed to title companies used in other parts of the country. This ironically makes the legal fees much more streamlined and cheaper.
Yeah, you're usually looking at under $1,500 for the attorney, which is significantly less than what buyers pay in neighboring states like Georgia or South Carolina.
But North Carolina also has a unique hurdle called the due diligence fee.
This is a critical thing to understand because it fundamentally alters the risk profile for you during that initial contract phase.
Right. When you make an offer on a house in North Carolina, you pay this due diligence fee directly to the seller, and it is entirely non-refundable. It basically replaces the traditional earnest money structures you see elsewhere. It usually runs anywhere from $500 to $3,500.
You're essentially paying the seller to take the house off the market while you conduct your inspections and get your loan fully approved.
And if you walk away because, say, the roof is caving in, the seller keeps that money.
It forces buyers to have genuine skin in the game before they tie up a seller's asset.
So with all these closing costs and due diligence fees stacking up, buyers naturally want to ask the seller to help pay for them. It's called asking for a seller concession. But you cannot just ask for a blank check.
The lenders care deeply about this.
Oh, absolutely. If a seller gives you too much money back, it artificially inflates the perceived value of the home, which messes up the math for the bank's underlying asset. So each loan program strictly limits concessions.
Right.
If you have a conventional loan with a small down payment, the seller can only contribute up to 3% of the purchase price. If you have an FHA or USDA loan or a conventional with 5% down, that cap jumps to 6%. And VA has a specific 4% cap on certain concessions, plus unlimited closing cost credits.
This raises an important question that trips up a lot of aggressive negotiators. What happens if you get the seller to agree to pay 5% towards your closing costs, but you're utilizing a standard conventional loan that legally caps it at 3%?
Do they just adjust the math for you?
No. The lender does not just adjust it, they will reject the contract entirely. The underwriter sees a violation of the program's strict asset rules and just stops the presses.
Wow.
Yeah, you have to go back to the seller, renegotiate the legally binding contract, rewrite the paperwork, and pray the seller doesn't just walk away in the meantime. You must understand the structural limits of the loan before you start negotiating the price of the house.
Precision is mandatory. Now, before we synthesize all this, there's one more structural lifeline. The North Carolina Housing Finance Agency offers the NC Home Advantage program.
A great program.
If you qualify and complete a buyer education course, the state provides 3 to 5% in down payment assistance. The really cool thing here is that it stacks perfectly with these other loans. You can pair it with a conventional or FHA loan to entirely cover that initial down payment hurdle.
It's an exceptional tool for bridging the gap if your upfront cash is a little light, but your stable income can comfortably support the monthly payments.
So what does this all mean? We've laid out the entire map. Navigating this decision tree requires understanding your specific leverage points.
Right.
If you're a veteran, you utilize the VA loan for its unparalleled federal subsidies. If you're buying outside the major city density limits, you utilize the USDA loan to capture those geographic incentives.
Exactly.
If neither applies and your credit score is pristine, like 720 or higher, you drive the conventional sports car to avoid lifelong insurance fees. And if your credit is sitting between 580 and 719, you use the FHA loan as a heavy-duty stepping stone, capturing a better interest rate now while planning a strategic refinance in 4 years. Having just one targeted conversation with a professional to map your reality against these 4 structural paths is how you avoid paying an invisible $50,000 penalty.
Absolutely. And, we just discussed how the strict rules of homeownership, the amount of cash you need up front, and the mandatory insurance premiums you might pay for 3 decades can change drastically based simply on which side of a county line you buy on, like crossing into a USDA rural boundary.
It's wild when you really think about it.
It makes you wonder,
Yeah.
how much is your current zip code dictating your financial future right now without you even realizing it?